let's start with the daily chart of all things, the volatility index, or the VIX for short, going back to 2020. Now, we often call this the fear gauge. You know, I focus on it a lot. But what the VIX directly measures is how urgently traders are buying put options on the S&P 500 to hedge their positions. In other words, things go down, they don't get hurt that bad. If you think of put options as insurance against stocks going down, the VIX reflects the cost of those insurance policies. How's that? When it goes up, it means traders are terrified. When it goes down, it means the fear is on the wane. Because the VIX and the S&P 500 tend to move in opposite directions, as you can expect, a peak in the volatility index is good news for the stock market. And Gartner sees signs of potential peak here. Specifically, the VIX, I thought this was fascinating. The VIX is making what looks like a head and shoulders formation, okay? That's a very reliable pattern, not a bottle of shampoo, that usually leads to this, okay? While the VIX is currently over 30, as long as it doesn't break 35 and start again, completing the heads and shoulders pattern, Gartner sees it heading much lower, perhaps back to the teens. Again, that would be usually bullish for the market because when the VIX goes down, the S&P almost always goes up. I was very surprised that the VIX didn't spike here. I would have expected that. It didn't happen. Therefore, I think that Gartner's onto something to think that we might have seen some sort of short-term end to the decline. But let's not get ahead of ourselves. Look at the biggest black hole in the market, the NASDAQ 100. Now, this is tech-heavy index. We heard a lot of people blasting FANG today. You know I'm not a supporter of FANG anymore. We've had to cut back some of these positions for charitable trust. There's just too many other great situations, and FANG is too overexposed. But this contains the 100 largest non-financial stocks in the NASDAQ composite. Now, this is, by the way, the worst start for these stocks since 2008. That's very important. It's nasty. Alphabet's certainly surprised. Elon Musk bid for Twitter, in part financed by margining Tesla stock doesn't help. Remember, when they margin the stock, basically the broker takes it. If the stock goes down, well, they'll sell it in the open market. All right, check out the monthly chart. Gartner says this picture is a nice reminder of where we are. And I think I think this was a disconcerting chart. While the NASDAQ 100 has pulled back hard over the last 5 months, right? The current correction is still minimal compared to the monster 20-month-long rally from the lows in March. So now you got to be looking at this, okay? See, this down versus this up, well, you get the picture. Remember, tech is unwinding now after an incredibly explosive move. That's what these moves are about. That was the Netflix and FANG. That was the Google tonight, although I don't think it's as bad as people think. Let's put it this way. From the bottom in 2009 to the peak in 2020, okay, so that's 11 years, the NASDAQ 100 rallied 7,000 points, okay? It's no speedometer, you don't have to worry about speedometers, no radar gun. That's just a nice pace. By contrast, the COVID rally covered 10,000 points in less than 2 years. If the index is stuck to its old uptrend, where would it be? Gartner points out that it would probably be around 8,000 points higher, not 13,000. It went up too far, too fast. Well, she doesn't expect to see a sell-off of that magnitude. She can't completely rule it out either. Even if the NASDAQ 100 only makes a 50% retracement of the COVID rally, that would take it down to 11,750. So we still have some downside, more than 1,000 points from where it's currently traded.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.